Okay, we're going to continue with our regular programming for now. We're talking about hedge funds today. Returns on hedge funds stalled for the most part in June. Still, they did keep attracting new money, and that suggests reports of the demise of the industry much exaggerated. This half hour, I'm speaking to the founder of Asia's best-performing hedge fund over the last 3 tumultuous years. He has some solid advice that should apply to retail investors just as much as the big guys. And both Google and IBM beating earnings estimates. Google shares slid, though, while IBM gained. That's all coming up here this half hour on the Bloomberg Edge. As ever, of course, do keep your emails coming in. The address is asiaedge@bloomberg.net. That's asiaedge@bloomberg.net. Keep your emails short and brief. And if you do have anything you want to send us from Jakarta, if you were at the scene or close to the scene and you have any information, please send them through as well. asiaedge@bloomberg.net. Now, it's a question most of us would have to deal with at some part of our life. Which mutual or hedge fund do you buy, and how do you pick a winning product? Pensions, insurance, government funds may rely on so-called funds of funds. These are professional asset allocators who would funnel clients' money based on their specific needs, firstly to strategies which they consider to offer the best return against risk, and the money managers who they think will be most effective in executing that strategy. Pacific Alternative Asset Management is one of the world's biggest funds of funds. That company, known as PAMCO, oversees $9 billion, including investments for CalPERS, the biggest US public pension fund. And PAMCO says it's time to boost its holdings in long, short, credit and equity funds, those funds betting on rising and falling stocks and corporate bonds. PAMCO says they'll outperform.
In particular, pension plans don't like the volatility that they've seen, in particular with their long-only equity investments in many cases. They're looking to hedge funds to deliver good equity-like returns, but also with lower volatility. So I do see a shift that will continue as pension plans and other institutional investors continue to move into hedge funds. And according to Eureka Hedge, long-short equity strategies are the second best performer this year. They're up 12%. That trails the 19% gain by event-driven funds, which bet on special situations such as corporate restructuring and mergers and acquisitions. Well, I'm joined now by James Chimside, founder of Asia Pacific Asset Management. That firm's Absolute Equity Asia Fund rose 4.7% in the year through to the end of May. It has had a total annualized return of almost 12% over the last 3 years. That makes it the best-performing fund of funds in Asia over that period. Also, the only fund of funds with positive returns both year-to-date, over 1 year, and over 3 years. Mr. Chirnside, sorry. Very good day. Thanks for joining us.
Good morning.
Tell me a little bit about the industry, because when there was all this chaos and concern at the start of this year, a lot of hedge funds were forecast to go under, and of course many of them have done. And a lot of regulation was forced to come in, and that was considered to basically fundamentally change the industry. But would you say the industry is now on an upturn?
Yeah, I think the last 5 or 10 years, in fact, there's been an enormous proliferation of hedge funds globally. I think, you know, at their peak, we were seeing over 100 new hedge funds a month being created. Now, as a result of that phenomenon alone, there had to have been a dilution in the quality of people being involved in the industry, I think, and consequently that has led to some very poor returns. But equally, you know, the guys at the top end of the curve have maintained a very positive returns, have managed through the most difficult period in financial markets post-Second World War extremely well. So there's some very good ones out there. I'd expect to see a number of hedge funds close as a result of becoming uneconomic, and you know, that's not a bad thing at the end of the day. But I think ultimately we will continue to see more money flow into the hedge fund space.
I mean, this is the important thing in terms of the way you allocate funds. You insist on transparency, don't you? You insist on talking to a fund manager, and if they've had a bad month, you want them to explain why.
Yeah, look, we do that, but I think where we've achieved a degree of success, particularly through the last few years, is that we've sought out managers with experience, people who are able or have been able to demonstrate their ability to deliver returns, And also, we've been pretty heavily weighted towards people with a clear flair for being able to trade markets. And with the volatility that has emerged in the last 18 months, 2 years, or even longer possibly, those trading skills have been extremely important in delivering returns.
And just a little bit, a very quick word, if you can, on your strategy in terms of holding cash or not. You don't hold cash. You let the managers do it, but you don't hold any for a rainy day yourself, yes?
We don't use cash as a capital preservation tool ourselves. Our investors give us money to invest. They themselves, as allocators, have their own trigger on their own cash levels, so we leave that to them to manage. We tend to put most of the money out pretty much the whole time.